Welcome to this edition of Hardman Talks. My name is Keith Hiscock. I'm the CEO of Hardman & Co. And I'm joined today by Yingheng Chen.
Hi, Keith. Good to be here.
Welcome. Now, Ying is one of Hardman's analysts who, among other jobs, works with me to produce our Hardman Insight series. So these are research papers looking at market issues such as how much do quoted SMEs pay in tax, how important are retail investors to the market, how frequent have capital markets days become. But today we're looking at liquidity. Now, this is one of the issues that everyone in the public markets is worrying about, from the government to brokers to professional investors. And Ying and I have just published a paper on the subject in collaboration with Winterflood Securities, the leading market maker in London. And that paper is called Liquidity, Shrinking When It's Needed Most. So, Ying, the first thing is, can you tell us what liquidity is?
The Oxford English Dictionary defines liquidity as the availability of liquid assets to a company or market. Liquid assets are assets that have a high volumes of market activities. In other words, liquidity is the lifeblood of markets, and measuring it over time is a way of gauging a market's health. Therefore, a market without liquidity isn't really a market at all. So, Keith, why is liquidity important, and what are the effects of poor liquidity?
Well, I'm sure many investors will remember the events at Woodford Equity Income Fund back in 2019, where the fund ran into a liquidity problem because of the holdings that it had. And since then, professional investors have increasingly focused on liquidity when making investment decisions. So, they may like a share or a company, it may fit all the benchmarks, etc., that they're looking for, but if the liquidity isn't good enough, they're not going to buy the shares. And generally, poor liquidity means that shares are less appealing to investors. The lower the liquidity, the fewer investors are going to be interested in the share. That makes it more difficult for the company to raise more money, and it means when it does raise more money, it's probably going to be at a lower multiple than a more liquid company might be able to achieve. It also makes it trickier for market makers, because if there's less trade going on, it's more difficult to make a price. So that tends to mean that the spread between the bid price and the offer price is going to be wider. So, Ying, how do we measure liquidity?
That's a very good question. There are several ways we can measure liquidity. One, we can look at the numbers of days of the shares are being traded. Secondly, the total values being traded. Or we can look at the percentage of shares in issue traded within the year. We use a variance of that in our report. We compare the values of shares traded with the average market caps of the year. Of course, if the result is 50%, that may not mean half of the shares in issues were traded. It might just mean that the same block of 5% has changed hands 10 times. So, Keith, what has happened to liquidity in the London market in recent years?
Well, sadly, it's gone down, and it's gone down by quite a lot. So our paper looks back to 2016 and compares it to 2022. So back in 2016, the total value traded of trading companies listed on the London Stock Exchange was 60.6% of their average market cap. So we're looking here at trading companies. We excluded investment companies and we excluded financial. So 2016, 60.6% of the market cap was traded. By 2022, that figure had fallen to just 44.3%. And it sort of doesn't matter what you look at, it's the same message. So we analysed the main market separately from AIM, exactly the same message. We cut the market into market cap bands, 9 out of 11 of those market cap size bands, the same message. If you look at it by super sector, 9 out of 11, the same message. Now, in some respects, I think you could argue this is more important at the smaller end of the market, because many professional fund managers will set themselves a minimum pounds million of liquidity, because they know they've got to get a holding of a certain size in their fund for it to be meaningful. And so as the number of companies where that pounds million of liquidity falls, more and more companies fall below a minimum threshold that they're looking for. So it'll be the smaller and some medium-sized companies that suffer from that. So Ying, why do you think liquidity's fallen?
As you mentioned earlier, Keith, this was partly because of what happened with the Woodford Equity Income Fund back in 2019. Also, there has been a reduction in institutional interest. For example, 68.2% of the London Stock Exchange was owned by institutional investors back in 1981, but by 2020, this number has fallen to just 31.6%. Lastly, there is a huge reduction in domestic pension funds allocation to UK equities. 25 years ago, this figure was 53%, and now is only 6%. So Keith, what can be done about that?
Well, before I answer that, I just want to go back and emphasize what you've just said there. So let's look at that again. So what we're saying is that 25 years ago, a UK pension fund allocated 53% of its investment capital to UK equities, 53%, whereas now it's just 6%. That's an astonishing change, isn't it? So you ask, what can we do about it? Well, I think it falls into three routes. The first is better communication between companies and investors and potential investors. And there are lots of parts to that. Part of that is improving the website, holding capital markets days or retail investor events, because retail investors can definitely improve liquidity. We've seen that, and in fact, you and I published a paper looking at capital markets days and retail investor events. And I think we demonstrated very clearly in that there is a very positive impact on liquidity. The second strand, I think, is more research. Now, the problem is it's not very commercial for brokers to write research about companies that they're not brokers to or that are not in the FTSE. Sponsored research solves that problem because it's paid for by the company, but it solves another problem, which is it's much more widely available than brokers' research. And then the third thing, I think, is in the hands of the government about doing something to channel more money into equities through, and it's looking at that in some of its reforms through making UK pension funds invest more in equities. Another thing that they've been looking at is perhaps changing ISAs, independent savings accounts, so that if you invest in shares, you're allowed to invest more than if you just stick it in a deposit account.
And will the proposed reform help?
Well, there are some proposals. Obviously, the devil's going to be in the detail when they get enacted. But the sort of things they're looking at are some of the things I've already said. So, ISAs, forcing UK institutions to invest in UK equities. But they've got some other ideas. So there's a proposal for a research platform which will commission research. That might be a positive. There's a proposal for a code for sponsored research, which I think will give more confidence to investors about the quality of sponsored research. And then they're looking ways at making it easier for retail investors to access research. So I think in conclusion, what we've demonstrated is liquidity has fallen dramatically. It's a problem both for investors and for companies wishing to raise money. And we've suggested some practical solutions for company management to improve their liquidity, and the government is working on some other ways to do so. So I think the problem's recognised. I think there is hope that things will get better as a result of all of these measures. So Ying, thank you very much for your time.
Thank you for having me.
And you'll find more detail on our notes on our website, which is hardmanandco.com. It's available for free there. And as always, thank you very much for watching. Please don't forget to like this video and join in the conversation wherever you're watching, and we'll see you next time.